Should you invest in the S&P 500 Bull 3X Shares ETF, SPXL? One of the most traded ETFs is the SPDR S&P 500 Index ETF, SPY, which tracks the S&P 500 index. If you're basically looking to invest in the broad stock market, SPY tracks the 500 largest US-listed companies. These include Apple, Amazon, Tesla, Visa, Pfizer, Coca-Cola, etc., the big players. But then there's another ETF called the Direxion Daily S&P 500 Bull 3X Shares ETF, SPXL. SPXL also tracks the S&P 500 index, but gives it some leverage. That's why these types of stocks are called leverage ETFs. 3x leverage to be exact, it triples the return of the S&P 500 index ETF, SPY. So if you're looking to maximize your returns, look no further than SPXL. But is the leverage worth it, and what are the risks involved? The SPXL is unique in that you don't have to actually leverage your account and risk a margin call or any of those sorts. SPXL already does the leveraging up for you, so there's some safety from the dreaded margin call. Over the past 5 years, the SPY has risen 66.03%, not bad. But during that same 5-year period, the SPXL has risen 129.9%, even better. And if you've seen my video about the S&P 500 Index ETF going to $0, you know that an ETF tracking the S&P 500 Index, SPY, unlikely will go to 0. So the same logic also follows for the SPXL even with its 3x leverage. The upside is obvious. If the S&P 500 Index goes up, so does an ETF tracking it, and more so with a leverage ETF. But there's also the downside with leverage ETFs. As I'm making this video, so far in 2022, the S&P 500 Index is down 14.01%. But SPXL, the 3x leverage ETF, is down 42.68% for the year. Everything is magnified with a leverage ETF such as SPXL. Now, there isn't really a problem with higher volatility inherent in an leverage ETF, but it may be psychologically sickening to watch. If you plan to look at your portfolio frequently, you're going to see some swings when things go bad. Granted, you can sleep well knowing SPXL isn't going to $0, but it still hurts. However, if you can get your mind on the fact that large swings are part of a leverage ETF like SPXL, you just might survive it. Historically, SPXL has greatly outperformed SPY. The SPDR S&P 500 Index ETF, SPY, began trading in 1993 and has returned 834.84%. The Direxion Daily S&P 500 Bull 3X Shares ETF started trading in 2007 and has returned 2,072.99%. Remember, both ETFs track the same 500 companies that make up the S&P 500 Index. Both are in lockstep when it comes to up and down days. The only difference is the 3x gain or loss when it comes to SPXL. In theory, there isn't any difference in risk. Both have the same risk profile. The only question is if you can stomach the roller coaster of SPXL if there happens to be a downturn. If you want a higher reward without needing to borrow money, SPXL may give you that safety net. So what are your thoughts? Are you invested in the stock market? Comment below. And as always, take care of your money.